Welcome to the Deep Dive. Our mission is straightforward. We take a stack of sources, pull out the most important insights, and give you a shortcut to being truly well-informed without getting bogged down.
Yeah, we're here to cut through the complexity, kind of extract the core knowledge, and help you understand what really matters in these often dense documents.
And today, we are tackling a fundamental source for understanding one of the world's most watched companies. We're doing a deep dive into the Berkshire Hathaway 2024 10K filing.
Right, this document is essentially Berkshire speaking for itself. It's what they provide to regulators, to the public, the official details on their business's performance and the risks they see.
It's a unique window, really.
Definitely, into this vast and, let's face it, often unconventional conglomerate.
So our guide today is only what's inside the pages of this filing. Our goal is to navigate this document together, pull out the fascinating facts, the critical numbers, and the key takeaways that the filing itself emphasizes about how Berkshire operates.
Okay, let's unpack this.
All right, where do we start? The structure, maybe?
Yeah, I think so. One of the first things the 10K makes clear is the management philosophy. It states, Berkshire Hathaway is managed on an unusually decentralized basis.
You hear that phrase a lot with Berkshire. The filing clarifies that the top decision-making group, that's the chairman, CEO, and the two vice chairmen, they handle the really big strategic stuff.
Like significant capital allocation, yeah.
Exactly. Evaluating the performance of the different businesses, choosing their CEOs, that kind of thing.
And what's really crucial here, and the filing explicitly says this, is how they separate that operational and capital allocation role from the investment decisions. Those are handled separately by the chairman, mainly, along with Berkshire's corporate investment managers.
So that split is core to the model. Running a business's day-to-day versus managing the big investment portfolio.
That's the idea presented. And the filing then structures its reporting around these key segments to help you sort of grasp the huge range of businesses they own.
Makes sense. How do they break it down?
Well, they group everything into insurance, which they actually split further into underwriting and investing.
Okay.
Then there's the BNSF Railway.
Right.
Utilities and energy, which is mostly Berkshire Hathaway Energy, or BHE.
Got it.
And then there's this massive, incredibly diverse category called manufacturing, service, and retailing. Oh, and they also mention interests in non-controlled businesses.
Wow. Okay. That structure gives us our roadmap then. Let's jump into those business segments, starting with what many people see as the real engine of the whole operation, insurance.
Definitely. The insurance side generates significant float, the premiums collected before claims get paid out.
Which they then invest.
Exactly. So the filing details this landscape, including the difference between admitted and non-admitted insurers.
Okay, admitted insurers.
Yeah.
That's what most people think of, right? Licensed in the states where they operate, and the states heavily regulate their policies and rates.
That's right. Stringent regulation. Now, non-admitted, sometimes called excess and surplus lines, or E&S, that fills gaps, covers risks the standard market might not touch.
More unique stuff, higher risks maybe?
Yeah, often. And because of that, they're subject to considerably less regulation on the rates they charge and the policy forms they use. Berkshire plays in both of these spaces.
The filing mentions the NAIC, the National Association of Insurance Commissioners. They set standards, but it stresses that the state where an insurer is actually based.
The domicile state.
Right. That state has the ultimate authority over its solvency, its financial health. So it's this mix kind of national standards and state-level control.
It's complex. And they also touch on TRIA, the Terrorism Risk Insurance Act.
Right, yeah, that came after 9/11.
Right. It requires insurers to offer terrorism coverage. But the filing specifically notes something important. Reinsurers are not required to offer this coverage under TRIA.
Oh, interesting.
And maybe more importantly, they're not eligible for the federal reinsurance backstop if a major terrorism event happens. That's a key detail for how risk is managed, especially in their big reinsurance unit.
Good point. And for their international insurance operations.
The filing basically says regulation varies widely. Germany, the UK, Australia, different rules everywhere, covering licensing, capital, reporting, just highlights the global complexity they're dealing with.
Okay, so within that big insurance umbrella, who are the key players mentioned?
Well, GICO is probably the most recognizable name for most people.
Definitely. Car insurance ads everywhere.
Right. Their main business is private passenger auto insurance, all 50 states plus D.C. They also do motorcycle, RV, boat, some small commercial auto.
And they sell direct, right? Online, phone.
Mostly direct, yeah. And some captive agents. They compete head-on with the big names State Farm, Progressive, Allstate, USAA. The filing actually states they were the third largest auto insurer in 2023.
Wow. What market share did it say?
12.3%. And because GEICO operates on an admitted basis, those rates and policies are heavily regulated state by state.
This competition is tough.
Fierce, yeah. The filing says it's primarily on price and service, and GEICO uses its own claims staff, which is another detail they mention.
Okay, GEICO. Who else in insurance?
Then you have the big reinsurance operations, General Re Group and TransR Group.
Reinsurance.
Yes.
Insuring the insurers, basically.
Pretty much, yeah. General Re and TransR are Berkshire's global reinsurance powerhouses. General Re covers both property casualty P&C and life health risks worldwide.
And TransR.
TransR, which they acquired relatively recently, end of 2022. It focuses on P&C reinsurance. They tend to work primarily through brokers.
And they write complex deals.
Yeah, things like quota share, excess of loss contracts, treaty reinsurance, some facultative, operating on a much bigger scale, kind of behind the scenes from the primary insurance companies most people interact with.
Gotcha. And there was one more, BHLN.
Right. BHLN is mentioned specifically for reinsuring traditional life insurance policies and also certain variable annuity risks that are basically in runoff winding down.
So the insurance group is really broad. Standard auto, huge global reinsurance, and some specialized niche areas, too.
Exactly. It's a core pillar.
Okay, moving on from insurance. What about heavy infrastructure? The filing talks about the BNSF Railway next.
Right. BNSF, one of the major freight railroads in North America. Huge network.
Its routes cover the western and southern U.S., right? And parts of Canada and Mexico.
Yeah, accessing major cities and ports. They also work with about 200 smaller short-line railroads and have marketing agreements with other big carriers.
How does the filing break down what they actually ship?
It details revenue by freight type. Consumer products is one category, industrial products, agricultural products, and coal.
Coal is still significant, then.
It is. And the filing notes how volumes and the rates they can charge for all these are affected by the economy, supply and demand, and, of course, competition.
And I imagine the regulatory side is huge for a railroad.
Oh, absolutely. Extensive and impactful. BNSF is subject to a whole alphabet soup of federal agencies. The Surface Transportation Board, or STB.
What do they regulate?
Rates, routes, sales, or abandonments of lines, mergers. Big stuff. Then you have the Department of Transportation, OSHA for safety, EPA for environmental matters.
And state laws, too?
Yep, state laws apply too. That regulatory landscape is really key because, as the filing points out, it dictates things like their obligation to transport hazardous material.
Which must carry risks.
Inherently, yeah. Risks of claims, potential losses, big environmental cleanup costs if something goes wrong. And environmental regulations and general emissions, waste disposal, water discharges. The filing says these significantly increase their costs and liabilities.
What about competition for BNSF?
The filing identifies Union Pacific as their primary rail competitor in the western U.S., but they also compete with other Class I railroads, regional railroads, and significantly, motor carriers, trucking.
Trucking takes a lot of freight.
It does. And the filing notes competition has actually intensified as the railroad industry has streamlined itself over the years.
Any other major challenges highlighted for BNSF?
Well, related to what we just said, that requirement to transport hazardous materials is listed as a risk.
Okay.
Changes in rail industry regulation could impact pricing and their ability to invest in the network. And financially, that significant portion of revenue is still coming from coal.
Right, you mentioned that.
The filing indicates that shifts in government energy policy or the move towards alternative fuels could really hurt earnings. And one last crucial point. The document emphasizes BNSF requires significant ongoing capital investment.
Just to maintain the network safely.
Exactly. It's a massive, costly infrastructure to keep running.
That need for huge capital investment. And that sounds like a theme that might carry over to the next big segment, Berkshire Hathaway Energy, or BHE.
It absolutely does. BHE itself is a holding company overseeing a really diverse portfolio of energy assets.
What's included under BHE?
The filing details 4 regulated U.S. utility companies, serving something like 5.3 million customers combined.
Wow.
5 U.S. interstate natural gas pipelines, over 21,000 miles of pipeline. Electricity transmission and distribution businesses in Great Britain and Canada. Plus, they're a major investor in renewable power projects, mostly wind and solar.
They also have that real estate brokerage business, right? Kind of random.
Yeah, it's in there too. An interesting outlier under the BHE umbrella.
So regulation must be intense for BHE as well.
Comprehensive is the word the filing uses. U.S. utilities are heavily regulated. Federal level, state level, even local agencies get involved. FERC, the Federal Energy Regulatory Commission, is a big one.
What does FERC oversee?
Wholesale electricity rates, transmission, grid reliability, utility holding companies, accounting, even issuing securities. And they can impose significant penalties for noncompliance.
And for the utilities serving customers directly?
The filing notes they generally have exclusive rights to serve retail customers in their designated territories, but also an obligation to provide service. Rates are typically set by state commissions on a cost-of-service basis.
Meaning they recover their costs and earn an allowed return on investment.
Historically, yes, though some customer classes or areas now allow for customer choice or self-generation. But the key point is that failure to comply with regulations, especially new environmental ones,
like air quality, climate change, coal ash disposal.
right, that can have significant adverse impacts, particularly if the regulators don't allow the utility to recover those compliance costs through customer rates.
Environmental risks seem like a major focus in the BHE section.
They are, especially wildfire exposure. The filing is very explicit about exposure to wildfire losses and related litigation. It really zooms in on PacifiCorp's situation.
PacifiCorp operates out west, right? Oregon, California.
Exactly. The filing details specific wildfires in their service territory in 2020 and 2022, and the ongoing litigation, particularly the James case in Oregon.
Were there specific verdict amounts mentioned?
Yes, jury verdicts totaling over $179 million just from rulings in 2023 and 2024, which the company states it intends to appeal.
That's substantial.
And it gets bigger. The filing also mentions mass complaints seeking a, frankly, staggering $48 billion.
$48 billion.
Billion, yeah. Now, the company deems achieving that amount to be of remote likelihood based on how cases have gone so far. But the filing does report cumulative estimated probable wildfire losses through the end of 2024 at $2.75 billion before tax effects and any insurance recovery.
That's still a huge number. How much was unpaid liability at year-end?
Estimated unpaid wildfire liabilities were $1.54 billion at the end of 2024. And crucially, the filing states clearly that it's reasonably possible that significant additional losses could occur.
But they can't estimate how much.
They say they can't estimate a range due to all the complexities, the number of properties, parties involved, legal uncertainties. It's clearly flagged as a major risk factor.
A very significant financial exposure tied to environmental events and litigation.
Definitely. And just like BNSF, the filing reiterates that BHE requires significant amounts of capital for its infrastructure. And again, the debt funding this is primarily at the subsidiary level.
And not guaranteed by the Berkshire parent company.
Correct. That's a consistent point they make.
Okay. Shifting gears quite dramatically now. We get to that massive manufacturing service and retailing group. This section of the 10K really shows the incredible, almost bewildering breadth of Berkshire Hathaway.
Yeah, this group isn't about one single industry at all. It's more like a huge collection of diverse businesses. Many are leaders in their specific niches, but the niches are all over the map. The filing doesn't, list every single one exhaustively, but it gives pretty detailed glimpses into some of the key players.
Like who? Give us an example.
Okay. Precision Cast Parts, PCC. The filing highlights they make these highly engineered metal components. Think investment castings, forgings, for really demanding industries like aerospace engines, airframes, also power generation, medical.
Sci-tech manufacturing.
Very much so. And a key detail the filing mentions for PCC is their reliance on specific raw materials: nickel, titanium, cobalt, others. These often come from very few global sources.
Which makes them vulnerable
to availability issues, price swings, affected by cartels, politics, labor issues, inflation. That's flagged. They also make fasteners, aerostructures, really critical components.
Yeah, who else?
Lubrizol. That's a specialty chemical company. Two main segments: additives for things like engine lubricants, and advanced materials, which goes into polymers, coatings, even beauty and personal care products, medical devices.
Very different markets.
Totally different. The filing describes them as an industry leader, really leveraging technology and formulation science.
What about IMC? You mentioned that earlier.
Right, IMC, International Metalworking Companies. The filing says they're one of the top 3 global makers of consumable precision carbide metal cutting tools. Think inserts, tool holders used in machining.
So industrial consumables.
Exactly. They operate worldwide under brands like Iskar, Tegutek, Ingersoll compete with hundreds of players from tiny niche shops to big global rivals. And their main raw material, tungsten carbide powder, mostly from tungsten.
Another potential supply chain vulnerability noted.
Yeah, they mentioned supply is generally adequate, but disruptions could cause issues.
Okay, this is already incredibly diverse. What else is in this massive bucket?
Well, there's a large rail and leasing group within this segment, too. Not BNSF the railroad, but businesses serving the rail industry. Like Union Tank Car Company, UTLX. Huge fleet, like 119,000 leased rail cars, tank cars, specialized cars. And BNSF, which leases intermodal tank containers globally.
So leasing assets to other companies.
Right. And things like mobile crane services, too. Then there's a huge building products segment.
Oh, I know Clayton Homes is in there.
Clayton is a big one, yeah. The filing notes they manufacture both off-site, like modular and manufactured homes, and traditional site-built homes, including zero-energy-ready homes now, and they provide financing, too. They completed something like 61,000 homes in 2024 between off-site and site-built.
That's a lot of houses. Who else is in building products?
Other big names you'd recognize? Shaw Flooring Carpet, Hardwood, Turf, Johns Manville Insulation and Roofing Products, Mytech, which makes engineered connectors and software for the building components industry, and Benjamin Moore Paints.
So major brands across the building materials spectrum. How did they do overall in 2024?
Interestingly, the filing notes that for Shaw, JM, Mytech, and Benjamin Moore collectively, revenues actually dipped slightly, about 2.8% in 2024 versus 2023.
Okay. But earnings?
Earnings actually increased slightly by 2.9%. The filing cites lower raw material costs and better manufacturing efficiency helping out, even though sales volumes were lower for some and SG&A expenses were up.
Shows the complexity even within one subsegment. What about consumer products?
Even more varied. Everything from Forest River, which makes RVs, trailers, buses, boats, sold through independent dealers.
Okay.
To Jazzwares, they make toys and consumer products. You might know their big hit brand Squishmallows.
Oh yeah, those are everywhere.
Exactly. Jazzwares owns or licenses brands like Squishmallows, Pokemon, Star Wars, Disney, global sales. They were acquired in late 2022 as part of the Allegheny deal.
So toys are part of Berkshire now. What else?
Richland Group Jewelry Manufacturing and Distribution, See's Candies, of course. Pampered Chef Kitchen Tools, Oriental Trading Company, Party Supplies, Fruit of the Loom Apparel. The list just goes on. It's a real mix of manufacturing and direct-to-consumer retail type businesses.
Incredible variety. Now, Pilot, the truck stop chain, is that in this group too?
Pilot Flying J Travel Centers. Yeah, they're often grouped with retailing service, although reported separately. Berkshire just acquired the remaining stakes, so they own it fully now as of January 2024.
How did Pilot do in 2024, according to the filing?
Their pre-tax earnings actually declined significantly, down about 42% compared to the full year 2023.
Ouch, why?
The filing points mainly to lower diesel fuel margins, driven by less price volatility compared to the prior year. Also, higher operating costs like depreciation, labor, marketing, maintenance.
Okay. What about McLean? That's another big distribution business, right?
Yes, McLean is huge. Wholesale distribution, serving convenience stores, mass market retailers, chain restaurants, military bases across the U.S. Think high volume, rapid inventory turnover.
Who are their major customers?
The filing lists Walmart at 17.3% of McLean's 2024 revenue, 7-Eleven at 13.2%, and Yum! Brands KFC, Taco Bell, Pizza Hut at 12.5%. So very concentrated with big players.
And how did McLean perform, in contrast to Pilot?
McLean saw a significant increase in pre-tax earnings in 2024, up over 39% compared to 2023.
Wow. So really different dynamics within this broad group.
Absolutely. Shows you can't just look at the segment total. You have to understand the individual businesses.
What about the service part of manufacturing, service, and retailing?
Right. That includes businesses like Flight Safety, which does aviation training and makes flight simulators globally, and NetJets, the shared aircraft ownership and leasing company.
Both heavily regulated, I assume.
Very. FAA, international bodies. The filing notes, they require comprehensive training programs. There's also IPS, another Allegheny acquisition, which does design, construction, and consulting for specialized facilities, pharma, biotech, data centers.
Okay. And lastly, automobile dealerships.
Yeah, they own a large group of dealerships, heavily concentrated geographically in Arizona and Texas. About 75% of their auto retail revenue comes from those two states.
Do they focus on specific brands?
They hold franchise agreements with 27 manufacturers, but the filing says about 90% of their revenue comes from Toyota Lexus, GM brands, Ford Lincoln, Nissan Infiniti, and Honda Acura.
Are those franchise agreements restrictive?
Well, manufacturers have framework agreements setting standards,
Right.
and individual dealership agreements have requirements and termination clauses. But the filing makes a point of saying that state franchise laws generally provide substantial protection to the franchisee, the dealer.
Okay. Phew. That overview, just based on what the filing details, really underscores the scale and the just sheer diversity here.
It absolutely does. You're not looking at one business or even a few related ones. It's this vast collection operating in wildly different markets, managed under that decentralized philosophy we talked about up front.
It's quite something. All right, let's turn to the financial picture then. What does the 10K tell us about the bottom line?
Okay, the consolidated statements of earnings. The headline number, net earnings attributable to Berkshire shareholders, shows a massive profit, $89.0 billion in 2024. Very similar to the $88.9 billion in 2023.
Which is a huge swing from 2022, right? Wasn't that a loss?
Exactly, a $22.8 billion loss reported in 2022. So that volatility is really striking when you just look at the total net earnings number.
But the filing provides crucial context for that swing, doesn't it?
It absolutely does. And this is maybe one of the most important points for understanding Berkshire's financials as presented in the 10K. It breaks out the results by segment. And when you do that, you see that the enormous swing from that loss in 2022 to the large profits in 23 and 24, it's overwhelmingly driven by investment gains and losses.
Changes in the value of their stock portfolio, mainly.
Primarily, yes. Due to accounting rules, unrealized gains and losses on their equity holdings flow directly through net earnings each period.
And what does management say about that in the filing?
This is key. Management explicitly states right there in the document that these reported investment gains and losses are often meaningless for understanding periodic operating performance. They go on to say these swings have little analytical or predictive value.
So they're essentially telling you not to focus too much on that bottom line net earnings figure because of the investment volatility.
Precisely. They direct your attention instead to the operating earnings of the underlying business segments. That's where the filing suggests the real story is.
Okay, so what do those segment results show?
They show a more nuanced picture. Insurance underwriting, for example, swung from a loss in 2022 to significant earnings in 23 and 24. That was largely driven by GEICO turning things around.
Okay.
Insurance investment income, the earnings from the float increased significantly each year, mainly thanks to higher interest income from their huge holdings of short-term investments like treasury bills.
Makes sense with rising rates. What about the railroad and energy?
BNSF earnings actually declined in both 2023 and 2024 compared to 2022. BHE earnings fluctuated year to year.
And the big manufacturing, service, and retailing group?
Overall, earnings there were relatively stable in total across the 3 years. But as we discussed, there were internal shifts like Pilot's earnings decline in 2024 being offset by stronger results from others like McLean.
So the segment view tells a much different story than just the headline number.
A much more operational story, yes.
Let's shift to the balance sheet then. What jumps out there?
The cash position, without a doubt. Cash, cash equivalents, and U.S. Treasury bills combined totaled a staggering $212.6 billion at the end of 2024.
$212 billion. That's enormous.
It's up significantly even from $121.8 billion at the end of 2023. That level of liquidity is just immense.
What about their investments, especially the stock portfolio?
The filing details their investments. Equity securities were valued at $263.4 billion at year-end 2024. That's actually down from the end of 2023, likely due to market fluctuations and maybe some selling.
And they mention the concentration risk here.
Yes, explicitly. It states that approximately 71% of the fair value of those equity securities was concentrated in just 5 companies at the end of 2024.
5 stocks make up nearly 3/4 of the portfolio value.
Correct. And the filing actually quantifies this risk. It notes that a hypothetical 30% drop in overall equity prices could result in an estimated after-tax decrease in net earnings of about $62.5 billion, based on their holdings at the end of 2024.
Wow. So that concentration have a direct, measurable potential impact on their reported financials and, as they note, potentially on the statutory surplus and ratings of their insurance subsidiaries, too.
Exactly. It's a significant factor.
What about the other side of the balance sheet liabilities? Anything significant there?
Well, the big one related to the insurance operations is unpaid losses and loss adjustment expenses. That totaled over $147 billion at the end of 2024.
Which ties back to what you said earlier about estimating those insurance liabilities.
Precisely. It reinforces that point about the inherent uncertainty. The filing notes these estimates involve considerable estimation error, especially for those long-tail claims like environmental and asbestos, and they could change in the future.
Okay. What about debt? Total borrowings.
Also substantial. $124.8 billion in total borrowings outstanding at the end of 2024.
Where does most of that debt sit?
The filing is clear. The majority sits within Berkshire Hathaway Finance Corp., BHFC, BNSF, and BHE and its subsidiaries. And it repeats that important point we touched on.
That the debt issued by BNSF, BHE, and their subs is not guaranteed by the Berkshire parent company.
Correct. That distinction is consistently made. They also mentioned the parent company itself issued a significant amount of Japanese yen-denominated debt during 2024.
Interesting. Okay, moving to shareholders' equity and how they allocate capital. What's the equity figure?
Total shareholders' equity reached $649.4 billion at the end of 2024, a massive number.
And the filing discusses their share repurchase program, guided by Warren Buffett.
Yes. The policy, as stated right there in the 10K, is that Berkshire repurchases its Class A and Class B shares whenever the price is below Berkshire's estimate of its intrinsic value, conservatively determined.
Is there a limit or time frame?
No minimum or maximum amount set and no expiration date for the program. But there is a key constraint mentioned.
Which is?
Repurchases will not be made if they would reduce the consolidated cash equivalents, and U.S. Treasury bills balance below $30 billion.
So they always maintain that huge cash buffer as a priority.
Seems to be the policy. The filing states they spent $2.9 billion on share repurchases during 2024.
And it confirms the famous no dividend policy.
Confirms it. No cash dividend declared or paid since 1967.
So that capital allocation approach, keep the earnings, reinvest them, buy back stock when it seems cheap, but always keep a massive cash pile that's fundamental, and the filing lays out the mechanics.
That's the picture presented, yes, based entirely on the 10K.
Okay, that gives us a solid grasp of the financial structure and the key numbers reported. Now let's try to synthesize some of the critical risks and challenges that the filing itself flags across all these diverse businesses, the risk factors section.
Right, that's always a crucial part of any 10K. Beyond the operational risks specific to each business segment, which we've touched on, it highlights some really broad systemic issues Berkshire faces.
Like what?
Cybersecurity is a major one they call out. The threat of viruses, ransomware attacks, things that could disrupt their systems, cause loss of assets or sensitive information, lead to remediation costs, and damage their reputation.
Makes sense for any large company today. What else?
Investment concentration. We just talked about that. It's listed explicitly as a risk factor, impacting not just potential reported earnings swings, but also the statutory capital and ratings of their important insurance subsidiaries.
So the portfolio concentration isn't just an observation, it's a named risk.
Yes. Competition and technology are also mentioned as persistent challenges. Intense competition exists in basically all their businesses, and technological changes always carry the potential to erode long-held competitive advantages.
Data privacy regulations.
That's highlighted too. New regulations popping up globally create compliance burdens, and failures could lead to reputational damage and significant economic penalties.
What about climate change? That seems increasingly relevant, especially for their energy and insurance businesses.
Very much so. The filing details climate change and greenhouse gas regulations as significant risks. It breaks it down into two parts, really. First, the physical risks from extreme weather events, think hurricanes, floods, droughts, and especially wildfires. These can damage their physical assets, particularly in the energy and railroad segments, and also directly increase insurance losses.
And the second part?
Regulatory impacts. New laws or regulations aimed at curbing emissions or promoting clean energy could significantly impact the operations, costs, and potentially the long-term viability of parts of their energy and rail businesses.
So both physical and regulatory climate risks are on their radar.
Explicitly stated. Then there's the risk of emerging claims and litigation. This is particularly challenging for insurance.
How so?
New theories of liability can pop up, litigation costs can increase unexpectedly. It just adds to the already difficult task of estimating those ultimate insurance claim costs way out into the future. The filing specifically mentions environmental and asbestos claims again here as areas of significant historical uncertainty.
And the wildfire litigation fits here too, I suppose.
Absolutely. The potential for large jury verdicts and mass litigation, especially related to the Pacificor wildfire situation, is specifically reiterated in the risk factors section as a significant and highly uncertain risk.
Okay. What other major risks are called out?
Changes in regulations and regulatory actions generally. This is a constant theme across insurance, rail, and utilities energy. Changes can affect the types of business they can conduct, the rates they can charge, capital requirements, investment flexibility, even their ability to pay dividends upstream to the parent company.
And it could hurt results.
Yes, the filing notes potential adverse impacts on results and capital allocation decisions. It specifically mentions the risk that utilities might not be allowed by regulators to recover certain costs through rates, which could directly hit earnings.
We also talked about commodity price risk for the manufacturing businesses.
Right, that's listed too. Businesses like PCC, Lubrizol, IMC use various commodities. While they try to manage this through pricing, the inability to pass on cost increases impacts results. The filing notes, they generally don't use derivatives to hedge this risk.
And finally, that need for ongoing significant capital investment.
That's framed as a risk too, especially for BNSF and BHE. If that capital isn't available on reasonable terms, or if major projects fail or don't deliver the expected long-term returns needed to justify the investment, that's a problem.
So a wide range of significant risks. Does the filing mention anything about governance or internal policies related to risks?
It touches briefly on a few things. It mentions their cybersecurity management framework is tailored by business group, with annual reports going to senior management and processes for incident reporting.
Okay.
It notes they have a policy for recovering erroneously awarded compensation, a clawback policy, and an insider trading policy restricting trading in Berkshire or other company securities by directors and employees, often requiring pre-clearance.
Got it. So, taken together, this section really paints a picture of a company navigating a truly vast and complex operational, regulatory, and risk landscape all over the world.
It really does. It underscores the challenges inherent in managing such a sprawling and diverse enterprise.
Okay, one last area to touch on briefly, the accounting notes. Why are these important?
Well, the accounting policies chosen within the rules of GAAP, generally accepted accounting principles, can significantly influence how results are reported. The notes explain some of these key policies and judgments.
What's the most important one highlighted?
Probably the use of estimates. We've hit this a few times, but the filing is very upfront, especially regarding insurance. GAAP requires significant estimates, particularly for those property and casualty unpaid losses.
And they state there's error potential.
Yes, the filing explicitly says these estimates are subject to considerable estimation error and might need to be adjusted in the future due to unforeseen events or changing conditions. That inherent uncertainty is baked into the numbers.
Which explains some of the potential volatility in insurance underwriting results over time.
Exactly. Another key policy note explains how they account for investments, particularly equity securities.
Right, the ones causing those big swings in net earnings.
Correct. For equities where they don't have significant influence, generally owning less than 20% accounting rules require them to carry these investments at fair value, with the unrealized changes in value flowing directly through the earnings statement each quarter.
That's the rule causing those huge, often meaningless investment gains and losses that management warns about.
That's the one. It's just how GAAP works for those types of holdings.
What about fair value itself? Is that always clear-cut?
Not always. The filing explains the different levels used for fair value measurement. Level 1 is easy quoted prices in active markets, like for most publicly traded stocks.
Okay.
Level 2 uses other observable inputs, maybe prices for similar assets. Level 3 uses unobservable inputs. That requires significant management judgment and modeling to determine a value.
So even the reported fair value for some assets can involve significant estimation.
For Level 3 assets, yes. And finally, the filing notes that goodwill and other intangible assets acquired in acquisitions have to be tested for impairment at least annually.
What does that involve?
Estimating the fair value of the reporting unit or business they relate to, which, again, requires significant judgment and assumptions about future performance.
So the bottom line from the accounting notes is that even with standardized rules, there's still a lot of estimation and judgment baked into the financial statements.
Especially for a company as complex and diverse as Berkshire? Yes. Those notes provide important context for interpreting the numbers.
Wow. Okay. We have really gone deep into the specific details provided in this Berkshire Hathaway 2024 10K filing.
We certainly have. We've navigated through that decentralized structure they described, explored the unique regulatory hurdles and operational challenges facing each of the major segments.
The massive capital needs of the railroad and energy businesses.
Right. The intricate world of insurance and reinsurance, estimating those long-term liabilities.
And that just incredible diversity within the manufacturing, service, and retailing group. Everything from candy and toys to jet engines and insulation.
And we looked at the financial bedrock, right? That huge cash hoard, the significant concentrated equity portfolio, the massive shareholder equity base.
But we also dug into why those reported net earnings can be so volatile because of the accounting for investments, and why management, in the filing itself, points you towards the operating performance of the segments.
And we synthesized the risks. The company highlights everything from cybersecurity and potential acts of terrorism to the really significant exposures related to climate change, wildfire litigation, the complexities of estimating insurance reserves, and just navigating the maze of regulations across so many different industries and countries.
It really drives home that this document, this 10K, isn't just some bureaucratic exercise. It's a comprehensive map laid out by the company itself, showing the vast scale, the intricate machinery, and the inherent challenges of running this truly unique, multi-industry global conglomerate today.
Yeah, it really demonstrates the sheer scope of what's involved in trying to manage such a varied collection of businesses, presumably successfully over the long term.
Okay, so based on everything we've unpacked directly from this filing, here's a final thought for you, the listener, to consider. Given this detailed picture, drawn from Berkshire's own disclosures, of the vast range of regulations, the significant environmental exposures like wildfires, the evolving liabilities in areas like insurance, what does Berkshire's stated approach to acknowledging and managing these diverse risks tell us about the fundamental nature of trying to build and sustain value in today's incredibly complex and interconnected global economy?